Relatively quiet last week, but don't expect that to be the case this week, given what's in store. Hello, everyone. Monte here, market analyst at IGUE. As always, let's go ahead and start out with some of the key items that we saw last week, especially when it comes to non-farm payrolls that released on Friday. Yeah, there were holidays. Move wasn't as great as we expected, but at the end of the day, let's say that the numbers were roughly in line with estimates, even if it's lows that we haven't seen in terms of growth out of the labor market. Unemployment rate, though, quite important in this case, that we saw that it dropped to 3.5%. There were weak points in the labor market leading up to this release. We saw job openings were a miss and below 10 million. You had claims, initial claims above 200K, its previous revised higher. Continuous claims were above 1.8 million. Also, challengers job cuts was a fourfold increase year to date in terms of layoffs compared to the same period last year. So overall, there were weaknesses when it comes to some of that labor data that we saw last week, but the household survey, though stronger than expected, helped the unemployment rate bring it down from 3.6 to 3.5%. And that means that the Fed, well, that means they got leeway to continue their fight, at least for the time being, in battling inflation, which we'll get to. Wage growth also, that was also seen as a relative positive in the sense that month on month, in line with expectations, 0.3%, year on year dropping further to 4.2%. So on a consumption point of view, that might be seen as a negative. When it comes to pricing data, however, given the stickiness, that's seen as a relative positive. And of course, leading up to this data, we had, let's just say, data points that were, well, raising fears amongst market participants that recessionary risks are clearly rising. Manufacturing and services PMI, definitely a miss last week out of ISM. And as mentioned, those weak points in the labor market. But the big focus when it comes to the week ahead, I'm going to discuss some of the other items, but obviously it's going to be Wednesday's US CPI. Now, NFP, this was the last report before we get the Fed meeting, which is going to be at the start of May, where markets are pricing majority pricing a 25 basis point increase, which will be its last, and still optimistic about rate hikes this year, opposite what Fed members expect. And when we saw the February readings that were released in March, when it comes to CPI, month-on-month growth was still very strong at 0.4%. The core stickier 0.5%. And when it comes to expectations, what we're going to see when it comes to March, yeah, the month-on-month reading is going to be lower at 0.3%. Core still relatively sticky. Month-on-month growth of 0.4%. You take a look at those year-on-year readings from 6% down to 5.2% base effects. Thank you very much for that. When it comes to the core CPI year-on-year, though, potentially rising from 5.5 to 5.6%. Those Cleveland Fed nowcasts, I think it was even higher at around 5.65, so could even, rounding up, could even hit 5.7%. But long story short, the idea here is that if you're looking at month-on-month growth, 0.3%, even if it's slowing from the month before, overall, Fed's target at the end of the day is 2%, and that means we need a reading month-on-month headline of 0.2%, if not below. But this is expected to be the big item, or one of the first big items this week when it comes to items to note. And then, of course, we got some other items. That's because we got more pricing data. Producer price is going to be on Thursday. Trade price data on Friday. You got the consumer inflation expectations out of U of M. Its sentiment reading, by the way, not too optimistic last time around. Also going to get some retail sales where expectations are it's going to contract. All these items, by the way, it's going to be in the report, the link of which is provided in the description, and I will go through that in just a moment. And then, of course, we got minutes from the latest Fed meeting. But here's the thing. CPI is the big item, the big hurdle that we got to get past on Wednesday. And then afterwards, attention is really going to shift towards earnings, namely those financial heavyweights. We got JP Morgan, Wells, Citi, BlackRock. They're going to be releasing on Friday. And in light of what we've been seeing on the financial front, I know a lot of that was regional banks. We are going to get one of the banks on Thursday, but regional banks and the expectation of how it's going to impact those small to mid banks. But at the end of the day, it is important to look at how those financial heavyweights themselves see not just the guidance for their own company, but when it comes to the economy overall. So a lot of times people like to hear what they have to say and their expectation moving forward, and it's going to kick off with them. So that's going to be on Friday. It's going to be crucial and no doubt noted. And globally, we're going to get some Chinese CPI and PPI data as well as trade data. You got central banks speaking from a number of members, including today. You got the Bank of Japan's Ueda, who's the new governor, given that Kuroda is now gone. You got Ueda. He's going to be speaking today, although given the way he's spoken in the past, any changes are expected to be gradual. But at the end of the day, no doubt people are going to be noticing yen, and they are going to be noticing, of course, the bond market, especially that yield curve control program. Bank of Canada's policy decision, by the way, that's going to be on Wednesday. No changes expected there when it comes to your key rate at 4.5%. I want to just go and pull up IG trading platform very quickly and take a look over here at gold prices edging a little bit lower. And that's because I want to do this every week. We're going to go sort of deep dive a little bit on some of the key products that exist in the report, namely when it comes to sentiment. And what I want to do is one thing to note in this case, when it comes to sentiment, as it pertains to gold, we've noticed that COT speculators, and they're still in extreme buy territory, unchanged at 79%. Silver COT has risen from about 59% to 62%. We reached a point where they were pulling back initially and getting out. We saw the longs getting out, shorts initiating a little bit before we had this move higher when it comes to gold prices. But they briefly went slight sell when it comes to silver. They were on the verge of doing so when it comes to platinum. Now they're back in extreme buy when it comes to gold. They're rising when it comes to their buys when it comes to silver. More so when it comes to platinum, still extreme sell when it comes to palladium. And that's going to be somewhat interesting in the next phase. I'm going to go ahead and pull up the report right now. And what I want to do is, as I mentioned, the link of this is available in the description. It's going to have all the key items for the week ahead, especially those in bold are the ones you want to note. But let's go ahead and pull up gold for a second. And one other thing I want to note is retail sentiment, which has dropped from 72% to 54%. I also want to point out that on this chart, the blue dotted line is retail sentiment. You can see that as prices went up, their buy sort of went down, and COT speculators, you can see that they initially pulled back a little bit on more than one occasion in the past. This is a weekly chart, so it's giving us a larger picture before rising again. So they're going with this right now. And of course, the key item when it comes to, there are positives to note. People going, oh, the dollar pulling back a little bit, especially in the current phase. Yields pulling back a little bit because any further weakness when it comes to bond values, which means rising yields, is going to hurt those bank balance sheets. So in the current phase, maybe they don't want that. So let yields sort of pull back a little bit, let bond values go up. And that's going to give the safe haven precious metal, the non-yielding precious metal, a bit of a boost. Though I do want to point out that maybe you want to note, one key item to note here is that when it comes to yields, real yields still being in positive territory at certain parts of the curve means that a lot of times that's seen as a relative negative for gold prices. And historically, based on where the real 10-year is compared to where prices are, there is still a very, very big gap. So it would not surprise me to see any large move or any repricing. And that's the reason why the overview is volatile and not bull trend. I want to go ahead and pull back and just take a look at one last thing when it comes to oil. Now, the reason why this is so interesting is because when it comes to institutional sentiment, it's released on Friday, but position are as of last Tuesday. So this is post OPEC Plus decision for those output cuts. Now, prior to that, I actually was noticing that buys was starting to pull back. Shorts were starting to get in. This is before the decision. So the anticipation was, okay, rising recessionary risk, maybe the demand might not be enough. So they were sort of going in, and the shorts were sort of picking up, and we saw them drop from extreme buys, which was around, before this, they were around 80, 81%. The chart also, oil's also on the report, so you can actually see where COT speculators were at the time. And we saw them sort of pulling back. Well, not anymore. Now they've started, the shorts clearly got burned. They've gone in and they went ahead and they've gone ahead and they've reinitiated a lot of those buys, and now they're back at 79%. I want to go ahead and pull up the report one last time before I say my goodbyes and take a look. It's still a bear average just because prices have been averaging lower, but you can see clearly that COT speculators back up here, and retail traders, by the way, they've been range trading this entire time, and it's worked beautifully in their favor. We can see that in this case, they were heavy buy at the start of last week. This is before the gap higher, and now they're in the middle. So we have seen a lot of longs get out, and it wouldn't surprise me if they try and range trade this situation. So they do need to keep in mind some of the factors that I've been pointing out in the commentary, whether I release it on the weekly market report or whether it comes to the daily market report that's released Tuesday through Thursday. If you're interested in receiving the report, let us know. Until then, I want to thank you guys so much for joining, and happy ticks.